Digital asset markets generate enormous amounts of data. Prices update constantly. Exchanges stream order books in real time. Blockchains publish transactions continuously. Custodians track balances across multiple systems. But more data does not automatically create better visibility. In fact, one of the biggest challenges institutions face today is that the data often doesn't align. This is the problem of data fragmentation. Market information is spread across exchanges, wallets, custodians, analytics providers, liquidity venues, and internal systems. Each source may appear accurate on its own, but institutions need a unified view to make reliable decisions. And when that view becomes incomplete, inconsistent, or delayed, risk becomes harder to measure. For institutional investors, market visibility is not just about reporting, it's about capital protection. Because if you cannot clearly see your exposure, liquidity, pricing, or settlement status, you cannot properly manage risk. The challenge begins with how digital asset markets evolved. Unlike traditional finance, crypto did not develop around one standard reporting system. Different exchanges define volume differently. Some include derivatives activity. DeFi protocols may report liquidity based on total value locked rather than actual executable depth. As a result, even basic metrics can vary depending on the source. Price, volume, liquidity, wallet balances, funding rates, circulating supply. And during volatility, those differences become much more significant. An institution may see one valuation on a market data feed, another on an exchange, and a third in its internal systems. Under calm conditions, the gaps may appear small. But during stress, inconsistent data can distort exposure, execution decisions, and liquidity assumptions. This is why institutions rely heavily on reconciliation. They compare exchange data, custody records, blockchain settlements, pricing feeds, and internal ledgers to create one coherent decision layer. Because the goal is not simply collecting more data, the goal is understanding what is actually true. And blockchain transparency alone is not enough. On-chain data can show wallet movements and transactions, but it cannot always reveal ownership structures, off-chain agreements, derivatives exposure, or internal exchange activity. That means visibility requires combining multiple layers of information together. Liquidity data creates another challenge. Markets may appear highly liquid on paper, while real executable depth remains much thinner underneath. High reported volume does not always mean institutional-sized trades can execute smoothly without slippage. That's why institutions evaluate liquidity based on resilience, depth, spreads, and execution quality, not headline activity. At Kenson Investments, data integrity is treated as a foundational part of risk management. Market visibility shapes execution, liquidity analysis, valuation, and portfolio control. Because in digital asset markets, fragmented data can make risk appear smaller than it really is. If you want to better understand how institutions build reliable market visibility in complex digital asset environments, visit kensoninvestments.com and connect with the team today.